Hey everybody, and welcome to Project Premium Harvest. My name is Matt. In today's video, we're going to be going over my portfolio for the 15th week of 2025, better known as April 7th through April 11th. We're going to be talking about the account's performance. We're going to talk about the distributions that were paid out from these high income ETFs. We're going to talk about how much money I made trading options myself. And then we're going to be talking about the changes I've made to my portfolio and then what I plan on doing in the future. So let's get started. For anybody that is a new viewer, I'm just going to give a quick overview of how this project started. Back in June of 2024, so almost 10, 11 months ago, came up with this epiphany. I'm doing all of the right investing for long-term wealth. I'm investing into 401k, maxing it out, maxing out Roth IRA, maxing out HSA. I have a rental property. I have a primary residence I bought. So I'm doing all of the right things for long-term wealth. However, my problem is I don't want to wait till 59 and a half. I'm currently 31 years old before I can see that money or the fruits of my labor. I get investing is a long-term game, but at the same time, is it possible to potentially maybe instead of retiring at 59 and a half, maybe retire at 40, 45, even at 48, like any little bit sooner, that's a win, because there's one thing in this life that you can never make more of. It's your time. You always make more money, but you can't get your time back. Therefore, I'm like, hey, how could we figure out a way that we can make a monthly income, weekly income, so that we can get to that point faster? So that's how the project started. Back in June of 2024, I took an $83,000 HELOC loan against a rental property I owned, threw that money into Robinhood, borrowed against it, invested in high income ETFs, and here we are today. That's how it started, but the project has evolved, and it's going to evolve as time goes on, as things get more efficient, as we realize what these funds really are. Let's dive into it. Currently, my account is valued at $87,607.35. The things I have changed in my portfolio since the last update video is I sold out of rdte and nvdy. The reasons why I did that is I am tired of NAV erosion. I rather just start owning the actual underlying and then running covered calls against it. I don't want to own a fund that's going to continue to deteriorate over time. rdte, since the fund has been accepted, has never had a positive total return. Therefore, I wanted to slim down the account and make it more effective. nvdy, I think, is a decent fund. Nvidia, the actual underlying, great fund, great long-term investment. However, I just am tired of the NAV erosion. And the reason why I really did this, sold out of these funds, is I did the math. If I just bought 100 shares of SPY, I would make more money in covered calls premium than both these funds combined, and I wouldn't have to deal with NAV erosion. Therefore, this is the way I'm going to be moving forward. Instead of buying into these like yieldmax and high income ETFs that have NAV erosion, I'm just going to run my own covered call options on these funds. And over this last week period, I only traded covered calls on the S&P 500 2 or 3 times this last week, and I made $1,600. And guess what? There was no NAV erosion. When they distributed the premium, they didn't pull it out of the share price to pay me. I just maintained my normal investment of the shares, and then I also got the premium. So let me move over to my spreadsheet, and I'll show you guys what I'm talking about here. So let's go over the details for running covered calls against the S&P 500, and the fund I specifically like to use is the SPY. So back on April 9th is when I sold out of rdte and nvdy. So then I bought about 100 shares of the SPY at the $4.95 price. And then I ran a covered call. So basically a covered call is 100 shares of an underlying that you're trying to sell to an investor. They basically paid me an upfront premium to reserve the right to buy my shares at the 505 strike price. And so they gave me $350 to reserve my shares. If they don't go up to the 505 strike price, then I would keep the shares. I would pocket the $350, and then I would just rinse and repeat and do this again. However, on the 9th, the share price went past the 505 strike price. So then my shares got assigned. So I ended up selling my shares at a $924 profit. And then I also pocketed the premium that an investor paid to basically reserve the right to buy my shares. For that one-day transaction, I made about $1,300. And then Tuesday there was a lot of hype in the market. They were talking about pausing tariffs. Therefore, the market shot up. That's the reason why my strike price was reached. I didn't actually want to sell my S&P 500 shares, my SPY shares, because I thought the $4.95 price was an absolute steal. However, the strike price blew past it. That I think on Tuesday, the SPY went up to like $5.40 a share. And so it just completely blew past it. So I basically lost basically I locked in my gain at 505, but then I missed out about another $3,500 of just appreciation because I wanted to run this covered call strategy. However, I didn't buy back in on the 10th because I thought the market was a little too crazy. I waited for the shares to cheapen out, and then I bought back in on April 11th at this about $527 a share. And that's why this is in yellow, because this is temporary and I'm just kind of using it as a placeholder to remind myself how much I paid for the 100 shares of SPY. And then on the 11th, I made $302 of premium. The strike price that an investor reserved to buy my shares at wasn't breached, so therefore I made the $302. I kept my SPY shares, and then on Monday, which is tomorrow, I'm going to rinse and repeat. I'm going to choose another strike price. I'm going to lock in another premium, and then I'm going to keep going until financial freedom. So that's what happened, and that's the reason why I got rid of my nvdy and my rdte. So I actually think I can make more money running my own covered call strategy. And guess what? If I hold on to 100 shares of SPY, there's no NAV erosion. This premium, none of this money was pulled out of the share price to pay me back. It's just net gain. So the plan is, this is only of me owning 100 shares, right? Imagine if I have 200 shares of SPY. This 350, well, it could have been $700, right? If I had 300 shares of SPY, this $700 could have been $1,050. And then keep going forward and forward. And so just over a year period, I chose a very conservative number. Let's say, for example, that the premium I sell every single day for the rest of this year is going to be $200. Kept it very simple. There are some days where it's going to be, $100, or some days where it's going to be $300. So basically, to meet in the middle, I chose $200. I like to keep things at an even keel. I want to dream realistically. You will make $200 a day, and then there's 250 trading days a year. So over a year period, I'll make $50,000 running this strategy without any NAV erosion. But there is downsides with this strategy. If the fund is trading relatively stable or going up, this strategy is great. You're going to be making a ton of money. But if for whatever reason you bought, say I bought at this 527 a share, and then S&P 500 goes down to 450 a share. So I'm basically stuck running very out of the money covered calls, making very low premium. I think it'd probably be like $5 or $10 a contract. And so therefore you run that risk. But long term, eventually when the S&P 500 recovers and it gets closer to that strike price again of the 527, the premium's going to go up, and then you'll start making more money. So there are like the downsides of it. And with this, how this market is trending, I think from what I observed, a little bit of technical analysis, the 200-day and the 50-day moving average have crossed, which indicators are indicators. If they cross, that means there's going to be a reversal of what the current trend was. So since they crossed because it was going down, theoretically, the market should be going back up. However, it's just a technical analysis. It isn't 100% accurate. It's just something to look out for and then potentially plan for if it is going to happen. Now let's go to the spreadsheets and then look at how the funds are performing and what my account looks like. All right, kicking it off with the weekly distributions. For April 11th, the total premium and the trades I have done accounted me for $2,672.06 of premium and trades, which was quite nice. That's the highest it has been since I've been tracking this at a weekly basis. I think the other closest one was about 2,500. So I basically beat that by 170. And that's what I want to see week over week. I want to see these premium continue to go higher and higher. I don't want it to be stagnant. I don't want it to go down in the negatives, which I've made some bad trades before. Okay, moving on to the account totals. To own everything I have invested today, I had to pay $296,724.15. If we can see back here in January 24th, the account was very good. It's at 301,000. That's the highest point it has ever been. But for April 11th, the account is at $232,266.24. When I sold out of to nvdy and rdte, I basically had a $10,000 extra buffer, which is not being, I didn't invest in it, so that's why it's not being showcased. So that's why it's showing about $10,000 less. And this number, if I would have stayed invested into nvdy and rdte, would be closer to 242,000 instead of 232. I just didn't reinvest the money, and that just basically brought my margin costs lower. So theoretically, I'm still down like $50,000, but the market still hasn't recovered back to its pre tariff news. And I am optimistic that this account will continue to grow higher and higher. Moving over to xdte, my initial investment into xdte was about $58,750. If we look at today's numbers of the April 11th, it's currently at $50,518.87. And as you guys can see, as with the market, it has continued to trend downwards. I'm currently reinvesting all of my distributions back into the fund that is below my cost basis. The moment that this fund recovers its share price and then it's goes above my cost basis, I will just start taking that premium and start, buying more SPY or buying more actual underlying good investments instead of high income ETFs. That's just thought process with xdte. The premium I made for April 11th was $269.87, which was quite nice. But like I said, if I were to sell out of xdte today, I could have made this $269 in one options from running a covered call on the SPY. So I'm very tempted to reduce my holdings of xdte and then maybe buy another 100 shares of SPY. Let me know in the comment section what you guys think I should do. Because if I were to do that, I wouldn't have to deal with any NAV erosion like xdte does. And I'd be making, somewhere between $100 to $300 a day running covered calls on an asset that doesn't deal with NAV erosion. Something to think about. And I'm thinking about potentially lowering my stake in, amzp, goop, maybe even gpix and jepq. Everything's kind of on the chopping block. We're trying to evolutionize, we're trying to evolve how this portfolio operates. I still like the idea of having another, like a fund manager or, somebody automates part of the process. But for the amount of time I have to put into run a covered call, it's not that long. I can do that right before I head to work, which is one of the main points of why I invest in the high income ETFs in the first place. I wanted to outsource the options to somebody else. But after about 10, 11 months of this project, I think it's a safer bet just to own 100 shares of a specific stock and just run covered calls against them with like a wheel strategy. Those are my thoughts. Let's continue moving forward. And I added a SPY graph here where currently I'm invested about $52,782 of SPY. And right now it is valued at $54,786.34. So I sold out today. I would be up another, $2,000. For the trades this past week, between running covered calls on my Oracle shares, so I made, I think, about $70 on running covered calls on Oracle shares. I'm choosing a 5 delta, which basically means there's like a 5% chance that the fund's going to execute or the option's going to execute. So the premium payment is not going to be as high because I'm choosing a very far out of the money strike price because I don't actually want to sell those shares. Versus SPY, I'm willing to sell the shares if the price is very attractive and lucrative. And it's like the fine balance between like the share price to premium. And it's kind of like a lever. You can change it a little bit. If you want a little further out the money, you can get more appreciation, but you're going to get less premium. But if you want more premium, the share, you're not going to get as much appreciation when you do sell it. So there's kind of like that balance of like every time you like move lever, like you want more premium, then you get less appreciation. You want more appreciation, then you're going to get less premium. It's just, this is how it works. Going over to the Oracle value, initial investment was $35,835. Currently, the Oracle has not recovered. It's valued at $31,490. Moving on, Oracle did have a distribution payment this past quarter, and the amount of money I'm going to get is $117.50. The distribution payment that Oracle paid out was about 50 cents a share, but that's over a 3-month period. So divide 50 cents by 3 months. Not very good. I'd rather just run covered calls. I make more money in covered calls. I made more money in the last 2 weeks running covered calls than 3 months of distribution or 3 months of a dividend payment from Oracle. Quite interesting. Moving forward, for amzp, my initial investment was $40,000 into the fund. Currently, amzp is valued at $32,387.36. So definitely a downward trajectory because of the markets, but I was paid out a amzp premium of $638.50. Moving over to Goop. My initial investment into Goop was $20,000, and currently Goop in my portfolio is valued at $17,592 flat. I did not receive a Goop premium over this last week period. And now let's move over to gpix. My initial investment into gpix, let's make this a little bit bigger, was $28,043.97. Currently, my gpix is valued at $25,666.64. If we look at the gpix premium, nothing was paid out for April 11th. And then moving over to jepq, my initial investment into jepq was $21,915.48. Currently, jepq is valued at $19,825.03. And there was no jepq premium. So that wraps up all of the trades and the distribution payments I have received for the 15th week of 2025. All right, guys, I want to note a couple of things. I want to talk about the HELOC loan and then what the values you saw in Robinhood. So for that $232,000 you saw on the spreadsheet, that's basically all of my investments that I had to pay for and their current value. And then what that you saw in Robinhood was at $87,052 mark. So basically, if I sold out of everything in Robinhood, I would be positive $87,000, but that doesn't tell the full story. I still have a HELOC loan that I took out to begin this project, and that's still valued at $45,597.37. So basically, if I were to be in a pinch, I would sell out and then I'd pay off the HELOC loan, and then I'd still be positive $41,455. So therefore, this project is not at $0. Therefore, it's still a continuing success, and let's continue to press forward. All right, guys, that wraps up the video. Hope you enjoyed it, and hope you learned something new about running options against a underlying. I think selling out of rdte and nvdy was a great move, so that for me to buy 100 shares of SPY, I made more premium in 2 days of trading a covered call strategy on the SPY than owning nvdy and rdte would have paid out in a month, which was quite interesting. So therefore, we'll see how these trades and these option strategy will play out in the future. And I'm definitely thinking about potentially lowering my investment into these high income ETFs. I definitely think there is a case to hold a small percentage of them and have it somebody outsource running some of the option strategy for you. But I think I can do it better just owning 100 shares of SPY, racking in the premium, and then if I happen to get the SPY shares assigned, I would just buy back in and then continue the strategy going forward and forward. And the reason why I like using SPY is because you can run dailies against SPY. For my Oracle shares, I can only run weeklies against them. But for the SPY, I can run dailies against them. So that's why I like choosing SPY over VU and SPY over just any other underlying. That's it for the video. Hope you're all doing well there. Hopefully your portfolios are doing well and recovering with this little bit of, bounce back, mad out, and I will see you at the next one.